Alex has come a long way. From confusion to clarity, income tracked, expenses managed, taxes sorted. But one question remains: what do these numbers really tell us? Welcome to Financial Analysis. Financial statements tell a story, but ratios bring it to life. They help you measure how your business is really doing. Let's look at 3 types of insights: profitability, liquidity, and efficiency. Profitability shows whether your business is earning more than it spends. A common metric is net profit margin. That's net profit divided by revenue. It tells you how much of each euro you actually keep.
Alright, time to crunch a quick number. I made 150,000 euros in total revenue this year, and after all my business expenses, I ended up with 62,000 euros in net profit. To calculate my net profit margin, I divide my profit by my revenue and multiply that by 100, and I get a net profit margin of 41.3%. That means for every euro I earned, I kept about 41 cents in actual profit. Not bad, right?
Liquidity shows if your business can meet short-term obligations. One common measure is the current ratio, calculated as current assets divided by current liabilities. A ratio over 1 usually means you're in good shape.
Alright, let's see how my liquidity looks. I've got 30,000 euros in current assets. That's things like cash, receivables, and anything I can turn into cash within a year. My current liabilities? 20,000 euros, those are bills and payments due within a year. So, my current ratio is 30,000 euros divided by 20,000 euros. That gives me 1.5. That means I have €1.50 in assets for every €1 I owe. Feels good to know I've got some breathing room.
Efficiency means making the most of what you've got. One simple ratio is the receivables turnover. You calculate it by dividing your revenue by your trade receivables. It shows how quickly you're getting paid.
Let's check how fast I'm getting paid. My revenue for the year was 150,000 euros, and my trade receivables at the end of the period are 21,000 euros. So, I divide 150,000 euros by 21,000 euros. That gives me a receivables turnover ratio of about 7.1. That means, on average, I collect my payments around 7 times a year. Not bad, but there's always room to speed things up.
These ratios don't live in silos, they're connected. A profitable business can still have cash flow problems. An efficient business might still struggle with taxes. Remember, a ratio alone doesn't tell the whole story. You need to compare it to something, your past performance, industry averages, or even similar businesses. That's how you know if you're doing well, or need to course correct. Financial analysis helps you see the full picture. Think of this as your business checkup. Review your numbers regularly. Spot trends. And most of all, use them to grow smarter, not just bigger.
These numbers look fine, but how do they compare to your last visit?
Wow, what a journey it's been. From figuring out invoices to reading financial statements, I've learned a lot, and I hope you did too. But this is just the beginning. In the next season, we'll dive even deeper into accounting, taxes, and how to really understand your numbers. We'll follow a new story, with fresh challenges, real decisions, and practical tools. So stay tuned. See you next season.